Prashant Jain from HDFC AMC, someone who has a very deep understanding of market cycle, how to value businesses, how to differentiate noise from value, and what should be a right strategy in this kind of an environment when everybody is simply obsessed with momentum and liquidity. Prashant, good morning. Thank you for joining us. I always look forward to our interactions, and what a coincidence we are talking to you when markets are at an all-time high and Diwali and celebrations are out in the corner. So first, wish you and your family a very happy Diwali and season greetings from ET Now.
Thank you very much for having me on this, and I heartily reciprocate to you, your colleagues, and all your viewers.
Well, Prashant, when world discovered the magnitude of a problem called COVID, Nifty was at 12,000. Today, world has discovered vaccine, Nifty still is at 12,000. So the levels may be the same, but the churn and the shape of the economy and shape of the earnings is going to change and is going to alter. What are your thoughts on the way how markets have moved? And are you delighted, surprised, and celebrating with the comeback markets growth and demand has exhibited?
So, I think clearly what has happened with COVID and the lockdown was clearly unexpected and completely, I don't think anyone could have forecast this. And this is what equities also highlight, that we can foresee, we can meet unforeseen risks. I think the impact of lockdowns will pass, but I think lower interest rates are probably here to stay for some time. And I think the investment demand should pick up, because when economy it's the consumption which is more stable component of the economy, and it is investments which goes up and down more, both in the physical world and also in the stock markets. And I think as the world over you try to revive the economy, and with the benefit of lower rates, and also because these stocks have been battered down, I do feel that cyclical stocks that maybe capex oriented companies, banks, metals, I think these have also lagged in this recovery, and therefore all to see, and that is where probably valuations are also more reasonable. So that's what I think would probably play out now.
Why has the recovery been so strong? Is it pent-up demand? Is it cost cutting? And is the demand real? Is it permanent? Is it here to stay?
So I think, if you look at the Indian context, I think we will get clarity on the consumption demand in few months. I don't think we can still conclude, because as you said, if cars are selling well, how much of this is due to pent-up demand? How much of this is due to preference for personal transport? I think we will figure out answers to that as we go along. I do feel that the impact on wages, especially in the low to mid-income segments, where considerable number of people are employed in the services sector, I think is going to be somewhat it's going to be there for some more time. And I also feel that what has happened in this period of lockdown, a whole lot of companies have experienced sharply lower costs. And this is telling these companies, look, that I can actually work with lower costs. So I think this will also put some pressure on jobs and wages in the economy. So I think it will be some time before we can really read into to what extent is the consumption going to sustain or how it is going to go. As far as the stock markets are concerned, I am not too surprised by the rally. And this is what we have been saying for right through this period. And the reasons are actually quite simple. Even if you assume a business makes no money in the current year, that is not the case for most businesses. Let's assume even if that is the case, it impacts the DCF value or the fair value of a business by maybe 5-7%. That's point number one. That's it, not more than that. The second is the cost of capital has fallen very sharply, both outside India and within India. And that probably more than offsets this loss of DCF value of 5-7%. And third, if you look at even at these levels, if you look at last 10-year returns of Nifty, it is in single digits and it is below the nominal GDP growth rates. So I think the markets, as we went into COVID, were not overvalued. And even after this recovery, almost a year later, I don't think they are overvalued. And finally, as you pointed out at the beginning, this index returns have been led by few stocks as of now. And I think a whole lot of other stocks have still got considerable catching up to. Yes.
You are a votary of value investing, Prashant, and value investing typically works when the macros are favorable, when valuations are trading below their historic lows, and when there is scope of a strong economic recovery. If the landscape is good for value investing, why is value investing not working?
And if I may add, when everyone gives up hope, that is precisely when value starts performing. So I hope everyone has given up hope on value stocks, because that will be good for this style of investing. See, I think, I really don't know when value will perform, how value will perform, but I think what is clear is that there is considerable value in a segment of the market. When dividend yields on very large, stable, growing companies which the bond markets consider prime borrowers, when the dividend yields are 1x, 1.5x, 2x, even more in some cases, and likely to sustain or grow times the bond yields, I think it is pointing to considerable undervaluation. And I have seen a few occasions like this in the past. 99, almost everyone had given up on value locally and globally. And many people had written that value is dead for good. And precisely that is when it came back. So I think it will come back because there is a strong tendency amongst people to chase momentum. Human nature is to basically avoid short-term pain. And that is what leads to these cycles. Because as I said again, ultimately a business is about DCF values. And when you have a situation, even if you assume zero terminal value in some businesses, if the entire payback is going to be there in 5 or 6 years, when interest rates are 5%, 6%, I think clearly there is very significant mispricing. And over time, I think this should correct. I think while value has underperformed globally and in India, I think there has been one more factor in India, and that is the how government has divested stakes in reduced stakes in PSUs. And fortunately, there is a rethink on that count. ETFs are unlikely, as the DIPAM secretary has repeatedly said now. He has confirmed it once again. And I think these buybacks by the PSU companies, I think is also very supportive that if the markets are not willing to buy your stock, no problem. I will reduce my floating stock in the market. I will reduce my equity capital. And I think over time, this will have a favorable impact on these companies. And these companies are buying back stocks at levels which will be earnings accretive, because the dividend yields on these stocks is more than the bond yields. So what these companies save by way of dividends alone every year will be more than what they pay as interest or loss of income on the cash deployed to buy back their stock. So I would say, this is also supportive of probably these stocks doing better in the future.
Prashant, to talk about a trend, and it's a trend which I think is a universal trend for the mutual fund industry. Markets at an all-time high, number of demat accounts are getting added up, But the mutual fund industry on an aggregate basis, I'm not getting into specifics of a AMC or a scheme, are getting outflows. Why is that happening? And how do you see that changing? Now that markets are at an all-time high, ideally mutual funds should get more inflows.
Nikud, what I have experienced, and I have experienced this couple of times in the past, and I'm sure you can go back and check the numbers. See, after a very sharp fall, and which is more often than not been in India, led by developments outside India like 9/11 or Lehman or Brexit or tapering, etc. Whenever the market experiences a very sharp fall, people have experienced those lower NAVs, and when the markets bounce back sharply, there is people who are worried and they experienced depreciation in their capital or investments. There is a tendency to reduce risk, and now that values have come back, let me move out a bit. So, and the rally has been extremely sharp. So I am not at all surprised, and I would feel that it will take maybe a few weeks or months for when things stabilize. I think these outflows will go down. And again, you have to see in the overall context that what do these numbers represent. When you count absolute values, they make large numbers relatively. But if you look at the overall size of the AUM, I don't think it's a very large number. And I would again say that equities, the really smart investors are the ones who are really patient, and people who have been extremely patient with equities in India have been rewarded quite well. The last few years have been challenging because, as you are aware, Nifty has delivered single-digit returns. But time and again, you can go back and see whenever Nifty returns were moderate for long periods of time, for 10 years, the next 10 years were extremely strong. And secondly, see, think of the world 3 months from today. Assuming lockdown is over, we get control over COVID, vaccine is there, and life comes back to as normal as is. So possible economies are growing again. And when you look at your fixed income investments, you will get 3 to 5% post-tax returns. In some cases, even lower than 3%. I'm sure a whole lot of people, savers, will be very disappointed with those returns. And therefore, I think over next few quarters and years, equity inflows will gain significant traction because Indian saver has rarely experienced such low interest rates. And I think these lower rates are here to stay, at least at the short end, for considerable periods of time.
So in that light, how do you see fixed income moving? Because, yes, please.
No, I think you also mentioned the issue about direct demat accounts opening at the same time. Then I would welcome that. I don't think there's a challenge. There is space for everyone. And I think what has happened is probably post the sharp fall in the markets after COVID and the lockdown. From those low levels, some small caps, some mid caps, and few large caps have experienced very strong returns. And very strong momentum is always attracts people to equities. I think this is also a time when people have been at home and the adoption of digital has been very strong. And combine that with extremely low interest rates, time on your side, time to look at screen, markets, whatever, and ease of trading. If you bring it all together, I think it is, I am able to understand what is happening on the direct stocks. And this is also a time when mutual funds have not done well relative to the benchmarks. The reasons for that have been discussed. 5 stocks have led to bulk of the returns, and individual companies have also had challenges around what stocks they bought. Overall returns have been low. So I think if you put it all together, I don't think I'm too surprised by what is going on. All I would say is that while people can do better than mutual funds, but some investors will certainly do better than funds. But I do feel that the majority is unlikely to do better than the markets or the funds. And why I say this is because there is a strong tendency amongst the majority of investors to simply chase momentum. And that is what has happened time and again. 99, it was tech stocks. 2007, it was interesting. The same utilities which no one wants to buy, they were the darlings of the markets. People were willing to buy them at 3 times price to book. And today people don't want to buy them below book. So there is a strong tendency to simply chase momentum. And I have experienced, and there is a very strong logical reason for it. Whatever the majority does in markets is unlikely to be a winning bet. And that is what you can see time and again. It has played out in pharmaceutical stocks, very popular around 2013-14. You know what happened to small mid caps between 14 to 18. So I am not trying to say that no investors will do well. And I would encourage them to do their homework, understand stocks well, remain diversified, stay focused on quality. And in my personal opinion, I think value is a very important criteria for successful investing over long periods of time. Yes.
Okay. When we spoke about banks last time, Prashant, they were beaten, they were battered. Your view was that economy will come back, banks will come back. Banks have come out with good set of numbers. So, do you still feel that banks have a long way to go? Banks are still available cheap. What are your thoughts there?
See, I think banks, it's not a very homogeneous set of valuations that you are seeing in banks. I think few things we need to keep in mind. One, I think the pain in the corporate asset quality is behind us, and I think there is very good evidence of that. And how the pain in asset quality in retail loans will pan out, I think that time will tell. And I don't think that pain in retail loans will be symmetrical or uniform across banks and NBFCs, because the profile of customers of large banks is very different from that of other players. It could be either NBFCs or it could be even smaller banks. And this is what I have said consistently and felt, that even the retail assets pain will be less for the large banks. And that is what we seem to be experiencing. Banks have provided adequately for that. And I think, as I said earlier, the adoption of digital has been extremely rapid. So large banks, good brands, good distribution that have good technology platforms that are digitally enabled, I think they will experience growth in market shares. So I think if you put all of that together, I think some of the banks are indeed trading quite cheap, and some of the very high quality banks are also trading at reasonable multiples, but they are clearly growing businesses. So over time, there should be some returns around there as well. I think what would be a really welcome for these banks and for the economy is the credit growth, which, as you know, has been quite weak. It is in single digits, around 5 to 7% is the bank credit growth. And over time, hopefully, as the credit growth picks up, I think that is the time when the valuations of these banks could improve even further, to my mind. Yes.
But in a low interest rate scenario, can banks have that kind of commanding margins? When I say margin, NIMs and spreads?
What has happened is in a way you are right that when demand for money is weak, pricing power goes down and your margins could be lower. But what has happened is, as I said, for the larger banks, there has been considerable gain in the low-cost deposits, in CA and SA deposits, which are very low cost. And therefore, the cost of deposits has also fallen in line with the interest rates. And therefore, the bigger banks, the stronger banks have been able to maintain margins. I think it is possible that NIMs even for these banks may come off by 5, 10, 15 basis points. But I think if credit growth comes back, the NII growth should nevertheless stay fairly healthy. And I think the earnings of some banks which are being impacted by reasonable provisioning costs, either because of COVID-related stress or otherwise, I think over time that should also go down. I think banks we should value on book value, price to book value multiples and on sustainable ROEs. And if you see in this case, I mean, in that context, I think some of the banks are free. In fact, some of the large public banks, they are virtually free because if you just adjust the value of the subsidiaries, the non-banking finance subsidiaries, what these banks have, I think you can see that the price to book value multiples are actually extremely low. So I think there is considerable value, at least in some of the banks which are trading at low price to book value multiples and are large banks.
The relevance and domination of Indian IT, Prashant, has only increased in the COVID crisis. Margins have expanded, demand has come back. Are we in for a good purple patch for IT for next couple of years, both for growth and for stock prices?
See, I think for business growth, I think there is greater clarity. I think business growth should be good because the whole world is rushing to adopt digital with a sense of urgency. And Indian companies are extremely well placed to benefit from that. And Indian companies have been able to perform admirably even when they adopted work from home. And I don't think some other vendors globally would have achieved that level of success. So I think that has added to the credibility of these companies. And besides, in these periods, even many on-site jobs or on-site people have been working from home. So the moment you work from home, even in an on-site situation, I mean, there is an increasing tendency or preference to move the work offshore because in any case, it is not happening on your premise. And because if you move it offshore, you also save a lot of money. So I think this whole trend of working from home, adoption of digital, and companies have also saved considerably on other costs, travel costs, marketing costs, etc. So there is also an ability to spend on technology. So need is there, ability is there, and to cut costs, you also move it offshore. So to that extent, I think all of this is supportive for continued growth for Indian IT companies. But this is what the market also knows, and this is why the multiples are rich. And that is why the outlook for stock prices, I don't think is that clear, because this sector is trading close to peak multiples that have been experienced in fairly long periods of time. And this is a fairly large sector as well. So while growth rates could move up by 1 to 3% for 1-2 years, I don't think it is easy to make a case that growth rates will move up materially and sustainably for these for fairly high multiples to sustain. However, I think one thing in the favor of these stocks is if you compare this sector with the consumer stocks, the FMCG stocks, the growth profile, the ROCE profile, the free cash flow profile, the growth rates are quite similar. Even the dividend payout ratios are quite similar. But the multiples are much lower compared to the consumer-oriented stocks. And therefore, even at the somewhat higher multiples, the dividend yields are quite respectable. They are between 3 to 5%. And if you compare that with the cost of capital today, I think it is not difficult to justify even these multiples. Yes.
Prashant, large part of earnings in India, at least a couple of years ago, was a function of, I hate to use the word, but crony capitalism, inflation, and rupee depreciation. Those factors are not at play. What would be the driving factors now for corporate India?
I think because last few years have been challenging for aggregate earnings. Because if you look at last few years, something or the other has been impacting the aggregate earnings. Banks' earnings were impacted for a few years due to corporate NPAs. And once that happened, some large companies, let's say Tata Motors, they took a big impairment. So once in a while, some companies had some challenging situations. I mean, steel companies went through a bad patch. And you are right that last few years have been challenging for growth in aggregate. And that is why we are seeing record premiums for companies that have delivered growth even in this environment. I think as I look ahead, I think while the consumer sector, the pharmaceuticals, the IT, the banks which were not impacted by the asset quality cycle, they will continue to grow earnings. Maybe a bit lower than what we experienced in the last few years, because last few years we've also seen a significant margin improvement. And overall credit growth is down due to lower inflation. So I don't think we can deny that. But I think as we look ahead, the earnings could become more broad-based. For example, metals, capex, the erstwhile corporate banks, they should continue to grow. I think utilities should post fairly strong performance over the next few years. One, because I don't know if you have noticed, but the power demand in India has been the first to recover. And in September, I think the power demand grew in double digits. And people don't look at power as a growth sector in India, but I think it is indeed a growth sector, because just 5% homes in India have access to air conditioning. And the moment you install a one-room air conditioner in a home, the power consumption literally doubles. Our power consumption per capita is one of the lowest in the world. So I think even utilities should participate. So I expect fairly broad-based earnings growth going forward. And what has also changed is that China used to drive metal prices lower. And I don't know exactly why. I mean, we are still working on that. But China is actually become an importer, and they are not impacting the export or the prices of metals at all. How sustainable this is, how long this will last, we don't know. But at least for the foreseeable future, the outlook for metal companies also continues to be pretty decent. Cement companies have done extremely well. Costs have gone down. So I think I would expect fairly broad-based earnings recovery. The sectors which may continue to be impacted, especially compared to last year. If you compare current year, then every sector will grow. But if you compare last year, then I think retail, multiplexes, airlines, these are some sectors that may take slightly longer to reach the earnings of what they were experiencing pre-COVID.
Well, it's a great way in which you've summarized your thoughts on the sectors. My next follow-up question perhaps is linked to what is happening in the world in terms of ECG. The ESG funds right now are getting inflows, and ESG means focus on governance, focus on companies which are environmental friendly. Is that an impediment for a fund like yours, because you have exposure to NTPC, ITC, and globally anything which has got to do with thermal, tobacco, liquor, those sectors are not getting flows?
Not liquor, liquor seems to be doing quite well. And I think this is a very important question, and we are also thinking about this every day. I do find a few inconsistencies in these arguments. I mean, after all, a car or a truck is burning petrol or diesel, which is a hydrocarbon. How is that different from burning coal? And in India, the peak power demand on every single day is between 5 to 9 p.m. in the evening. At that time, there is no sun. And it costs 10 rupees or more to store a unit of power, single unit of power. And that is 2 to 3 times the cost of power itself. So till the time storage becomes economically viable, who is going to pay this 10 rupees extra for the power? So, I mean, I'm not saying we should not care about the environment. I mean, I'm all for it. When it comes to social, I think it is extremely subjective. And I mean, I would say a car company should have the similar, which is making IC cars. The issue is exactly the same as a thermal company. And for a moment, let us assume that India does not produce coal power. Then what happens? Will this 1.3 billion people go without power? Does that not have social costs? So I think it is very easy to, opine on these issues without looking at the ground realities. And I think the realities on the ground is that the coal demand in India and the demand for thermal power will continue to grow for considerable periods of time. And I think that's the reality. And India will actually need to invest in few more thermal power plants. Only when solar power storage or power storage becomes very competitive, which could be probably 5-10 years down the line, that is when you will have a viable alternative to thermal power. And as I said earlier, I find little difference between burning petrol, diesel or coal. After all, both are hydrocarbons. And if you leave coal in the ground for maybe 1 million years more, it will probably convert to coal or gas. So I think it is a phase, it will pass, because ultimately, if a stock is going to pay back in 5 years, and the life of that business is beyond that, if no one else is interested in buying that stock, that company hopefully, ideally should keep on buying back its stock. And over time, I think that stock should also do well, yes. And I think there is one more point which I could add here probably. As solar power becomes more competitive and more relevant, I don't see a reason why the existing thermal power generators, they will not move into solar power. If they could put up thermal power plants which are far more complex than putting up solar plants, which is, I am sure you know, to put up a solar plant is relatively simple. So I see no reason why they will not do the same. And NTPC, for one, I think has already announced that by 2030, I could be wrong here, 30% of their power should be generated from non-thermal sources.
Great point. So just two more quick follow-up questions, and let's spend a minute to understand the importance of low interest rates. Last time when interest rates were this low in the system, it kick-started a housing boom, it kick-started demand for HFCs, it kick-started an auto boom. What is the best way to capitalize on this low interest rate environment for an investor? Buy real estate stocks, buy home improvement companies, because the same factors which were at play last time, which is low interest rates and high need for housing, if those same factors are applicable today, do you think the same cycle will repeat itself?
Prices track earnings growth over very long periods of time, but they could diverge significantly for even 5-10 years. As I gave you a clear example, if you look at the utilities stocks 10 years back, they are a fraction of what they were 10 years back. But the businesses have grown in this period. They are up maybe 3x. So it is telling you that the business has doubled or trebled or even quadrupled, but the stock is half. So, business growth itself all the time does not mean stocks will simply mimic it. So I think we have to pay a lot of heed to what we are paying for that business, for that growth. And 10 years back, people were willing to pay 3 times price to book for utilities, which was wrong. and everyone lost money. And we know what popular IPOs came in utilities at that space. And people were instead not willing to buy FMCG and Pharma 12 years back. It sounds bizarre today, but that is how the markets were. So I think, yes, you are right. Lower interest rates are good for home sales. They are good for automobile sales. They are good for capex over time. They are good for credit growth. And if all of this happens, I mean, if credit growth is there, if capex is there, if home loans, then steel, cement, paints, everything kind of starts growing. So I think over time, due to the focus of the government, due to the large manufacturing opportunity that India has, and we've been extremely lucky because China is facing rising costs. It is people are trying to de-risk the supply chain due to COVID-related stress on the supply chain away from China. And we have intense focus after the border standoff to do things to indigenize, to reduce imports, to make more here. So I think all of this is pro-growth and growth will come back. But I think we should not ignore the valuations, because if you bought IT in 2000, for very long periods you made no money, despite the fact that the businesses grew every single year. If you bought Pharma around 2013-14, you are down 50-70% even today. Why? Because the businesses were overvalued. So I would say that for successful investing over long periods, the business is very important, the growth is very important, but equally important is also what price are we paying for it.
Right. Prashant, fantastic to have you back. We've really covered a whole range of sectors, your thoughts on value investing, importance of identifying a good company, but a good company at a good price is where you'll make great returns. A good company at a bright price, you will make not returns. Once again, wish you and your family and your team a very happy Diwali, and I certainly hope to see much more of you going forward.
Thanks, Nukuj, and wish you and your viewers all the best in a great year ahead. And thank you for having me on this show. Thank you.